Welcome back, everybody, to Coast CRE Academy webinar that we're starting to host now weekly. So we're really excited to have everybody come back here and joining us. We're going to talk about a big, really important webinar this time. I think a topic that everybody is curious about and is probably one of the cornerstones, really, of real estate, which is financing, doing debt, finding that, really putting that kind of piece of the puzzle together, unless you're like a really rich dude that can go and do all this in cash. Most of the people are going to be pulling debt. But by the way, here's a full freebie for those webinar people who have kind of showed up today. Buying something in cash, all cash, is actually not as profitable as buying something with debt. Putting debt on there is going to always increase your returns. It's going to make more money for you. It's going to always be better in the end to take debt on a property than buying it all in cash. Now, I know a lot of people are going to be confused by that and kind of wanting to get more explanations, so we can get into that later if we want. But to kind of give you a very rough overview, if you think about it, if you have $100,000, you could buy one house, or if you could buy 10 houses and put debt on them, what would be a better strategy? And for me, it's always going to be, buying the 10 houses and putting debt on it than buying the one, because you'll slowly pay the debt off. You'll own more assets quicker than if you're just owning one. And also the sense that where you're having 10 properties, you have 10 different cap rates, or even 10 of the same cap rates, and you're still making more in the long run by doing that. So a little freebie in that one that we can get in later when we do more underwriting. So today we're going to talk about the types of real estate financing, which is the overview of common financing, which is things like mortgages, mezzanine, bridge, and then equity versus debt. One of the most important parts is capital stack and the waterfall structures. So if you guys are ever looking to bring on syndications or any kind of other investors, things like that, the waterfall structures are going to be very important. We're going to talk about loan applications and the approval process, which is the steps to prepare a loan package, navigating the process from application to funding. And then we're going to look at a little case study at the end, which should be kind of easy, but we'll be able to use some of the skills that we've been learning. So first off, we're going to talk about mortgages. So what is a mortgage? And a mortgage is a loan secured by commercial property used for acquisitions, refinancing, or development. The key purpose of this is to provide capital to purchase or improve income-generating properties. So you can have bridge loans for that, acquisition loans, or if the property is stabilized, there are others, different types of loans to do as well. So you have things like retail centers, office buildings, industrial warehouses, multifamily apartments. You can also have hotels, self-storage units. There's lots of different, all those different kinds of food groups. Then, of course, you have really three kinds of different mortgages that you can do, which is fixed, variable, and interest only. So with fixed, obviously, it's going to be a fixed interest rate over the life of the loan, which would be 5, 7, 10 years, could even go up to 30. The variable is one that's, like it says, it changes, but it's changed on a schedule. So part of your loan documents, you'll see that it could either be changes yearly, it changes, every quarterly. There's always a different ones, but it will change, and it'll be laid out in your mortgage docs, and that will be clearly explained to you. And then the variables are also done on some sort of index, whether it's, say, the Wall Street Journal Prime, some of the treasuries, SOFR, those kinds of things. It can all be on that, and then plus a spread. Now, what do I mean by a spread? And that's basically the profit margin for the bank or the lender. So they're taking that money on the 10-year or the like, or whatever index that they're using, and then their spread is usually their profit. But then that, of course, remember, don't think it's just going into the hands of the greedy banks. They still have to pay underwriters. They have to pay a lot of security, especially if they're a bank. They have to do that to keep people from trying to hack the system and steal all the money. And I mean, you joke, but I mean, it happens a lot more than you think it was. Just a very quick story. I used to work for a bank, and it was a small regional bank in Florida, and people from Russia were trying to get in and things. So they have a lot of upkeep costs. So that spread is basically their profit margin, and it usually will stay fixed. And if the index jumps up and down, say SOFR or the 10-year, the Treasury, when it changes, if it goes up, it will help you. If it goes down, it can help you a little bit, but there will always be a floor. And what do I mean by a floor? A floor is a set lowest minimum that it can go to. Even if the index drops below a specific set rate, it doesn't matter. You're going to be stuck there. Let's say, for argument's sake, it's 6%. So if the index plus the spread goes below 6%, it won't matter. It'll stay there. So going on the next one, we're going to go to interest-only loans. So variable rate mortgages and interest-only loans can be the same, because interest-only can also change as well. It can also be part of a variable, and it can also change on a preset time frame, or it can also be fixed. So it could be either or. Interest-only is something that a lot of people like. A big reason for that is, yes, you're not paying any principal. You are usually having a lower payment. So there's more cash flow that's coming into you from the property. The problem with this, though, is that you're not paying the principal down at all. So once you go to sell the property, you're not going to get as much out of that appreciation as you would have if you were doing principal and interest payments. So interest-only loans are really only something that people look for when they're doing a particular part of the life cycle of the property. Usually it's right at stabilization. So they want to actually have a little bit of increased cash flow if they put a lot of money into the property. And then after that, they'll switch to a fixed rate mortgage where it actually amortizes. And just to stop for a second, I probably said something you're going to ask, what is amortization? And amortization is how the loan is, as far as the yearly time frame the loan is paid off. So if you were to go to 30-year amortization, that means that your principal and interest payments, if you pay those every month for 30 years, the loan will be completely paid off. So if you shorten that amortization period to, say, 20 years or 10 years, then the payments go up significantly because the loan has to be paid off in full in that amount of time. So when you're looking at the interest-only loans, going back to that, if somebody wants to amortize the loan after the interest-only period because they need cash flow to recoup, money they've probably put into the property, they'll look at doing interest-only loans and then go to an amortization. So all three of these things really they're all for different things. They're all for different parts of the life cycle, and they're all for different kinds of real estate, and not one of them is the best. People will say that, oh no, I only do fixed rates, or interest only are terrible, or variables are not that great. But I've seen plenty of people make tons of money doing any and all of those of these different kinds of mortgages. So we did talk about a few of these things. We're going to unpack them a little bit more. So loan terms can typically go from 5 to 30 years. They usually are between 5, 7, and 10 for most lenders. Most kind of loans and things that our listeners and everybody here on the webinar are going to be looking at are going to be in that 5 to 7 to 10 year range. When you get into very long-term holds with different lenders like life companies or agency loans or things like that, you can get into that 30-year territory. But most banks, definitely bridge guys, and most lenders are going to stay in that 5, 7 to 10 years, or even 18 to 24 months if you're looking at kind of bridge loans. Down payments can usually be anywhere between 20 to 30% of the property's value. It also can change based on lending parameters, which we'll look at later on, is looking at the NOI of the property. The NOI can really dictate and can constrain the loan, or it can really help it. So that's a very important factor when you're actually looking at what you're going to have to be doing as far as for a loan. If we're going to go and kind of, in a sense, argue in a vacuum, or just look at it in purely an academic sense, you're looking at anywhere between 10 to 30% is what you'd have to look at in down payments for any of the kind of different loans that you'd be seeing out there. And remember, we told you about the amortization period. We talked about that. So you have longer ones at 20 to 30, shorter ones to 5 to 10. Would not recommend the 5 to 10 shorter ones. Those have very, very high payments. Unless the property's really making gangbusters money, it's probably never a good idea. It's better to sit in those 5, 7, and 10-year loans with a 20 to 30-year amortization. Most lenders on a semi-permanent basis are going to be probably at 25, and there are a few that are at 30, but most are at 20 to 25. Prepayment penalties. This is one thing that you guys are going to learn, and a lot of you will not like, or it's one of the biggest hangups in a lot of mortgages. They have these things called prepayment penalties to basically prevent you from paying upfront or paying early. And I'm sure a lot of you guys would think, oh, why wouldn't the bank want to do that? Why wouldn't the bank want to get their money back? Well, when the bank does this and they give out a loan, they are looking at, okay, how much am I going to make over these 5, 7, 10 years? How long am I going to do that? And they think about that and they plan for that and they budget for that. And then if you come and pay them off early, let's say you pay it in half the time. Well, now there's a whole other 3.5 years or 2.5 years that they're not going to be making that money anymore. So they want to make sure they at least kind of can shorten that as much as possible, or at least make sure that no matter what happens, they will have pretty much made all of their money that they had planned to. So they add in these things called prepayment penalties. And they can be, so if you have a 5-year deal, they can be 5% in the first year, 4% second year, 3, 2, 1, and it can be a step down. You can have ones where it's 5, 5, 3, 3, 3, and then it's done. You could have one where it's only for 2. You can even have some that don't have any prepayment penalties. That's where a lot of people go. So it's a lot of different things that you can look at and happen and want. And it's, again, something that can be negotiated. It's definitely something that's always easily negotiated with lenders. So we already talked about the different kind of options. And we have the fixed rate, variable, and interest only, which we've really gone over. To quickly go over one more time, we have fixed rate loans that are their interest are fixed before closing, and they have a specific time in which they are fixed. So that's usually a little bit before closing. There's only one type of lender, which is a life company, a life insurance company, that will actually lock your rate in at application. So as you're going through the months process, the 30, 60, 90 days process of closing, your rate is fixed for that amount of time. I've had several deals recently where they have gone almost completely bust because rates have risen so quickly. We watched the 5-year go down 80 basis points and then go up 1% within a month, the time that I was doing a loan. So it's a godsend sometimes to have a fixed rate loan. Variables are where the interest rate can change based on a set schedule and is tied to an index plus a spread, which is what we talked about. And then the interest only is there's no principal is paid, and it's only the interest that is paid back to the lender, and then the principal is paid back at maturity or at sale of the property. We have the key features, which is things like loan terms, which most are done, like I said, in the 3, 5, 7, and 10-year loans. We have down payments, which are anywhere between 10 to 30%. As you see down below, some lenders can go as high as 90%. We have a few of them that we know of. The amortization, the prepayment penalties. So we want to make sure we always have a high amortization, and we want to try to make sure we always get rid of those prepayment penalties. So what are the different kinds of lenders? What are the different ones that we can do? Well, some of the most common ones people know of are banks or credit unions. They can offer pretty competitive rates, but they have extremely strict underwriting criteria and really can be based on relationships, especially with the bank. If you come to them and you have no relationship, they're not going to be very nice. The more you've done with them, the more money you have with them, the much nicer they'll be and the more that they'll work with you. So maybe the first couple of deals that you do with a certain bank or credit union that are local may not be the easiest, but the more that you do with them, the easier it could get. I have to say their job is pretty much to say no. That has kind of always been my experience with them. They can be very hard to get a deal done. But I will say once they say yes and once the credit gives the thumbs up, there's no backing out. They always will meet you at the altar and get married and go forward. So as long as you can get past credit and get past the approval process, you're able to go. But credit does love to say no. And then we have life insurance companies. They favor stable, high-quality properties. They have long-term leases. They are much lower in their loan-to-values that they do. They will top out at around 65% at loan-to-value. They do not like to go higher than that. So they have a lot of advantages, but they're more for very stabilized properties, very long-term leases that you just kind of want to fire and forget on. And these are great for long-term holds, and they offer flexible amortizations. They offer a great rate lock application, but these are for very kind of specific properties. We have commercial mortgage-backed securities, or CMBS, and these provide loans and then they bundle them up into securities and then sell them to investors on Wall Street. So actually a lot of the office buildings in New York City are done on CMBS loans. A lot of our economy actually is based on office buildings in New York City. And then we have private lenders, guys that are just out there, and these guys can be great. They can also be your worst nightmare. They can really help you out of a sticky situation. They can also easily take your property from you. So be very, very careful if you step into this world, and only step in there unless you absolutely have to and you have no really other options. And if you do, be careful, because they are basically loan sharks. These loans can really help you out, or they can completely ruin your entire deal. They can ruin all of your career and make it to where you cannot do real estate anymore. I highly discourage them for doing private money loans, because if you get foreclosed on, if something happens, which these guys would love to do, it makes getting loans from banks and other people much, much harder. Let's talk about bridge loans. Now, those are short-term financing used until permanent financing is secured. This is a different kind of loan than the others that we've talked about, and it's one that's used a lot, actually, especially recently. So an example would be an investor would be using a bridge loan to close on a property quickly while awaiting traditional financing. Or if he wanted to buy a property that was not quite stabilized and needed to put money into it, whether it be through renovations or whether it be through, updating the property or adding new amenities, those things would also be used for a bridge loan. And a lot of these bridge loans can offer money to help improve the property, because if they know the after repaired value of it is going to be better and will be able to get taken out by the permanent financing, they will sometimes allow for that. So the bridge loans can be really great. There are a lot of options out there, and a lot of people are trying to get into that space, which is wonderful. An example would be they have flexible terms, but they also come with higher interest rates and points. They can be variable. They can be interest only. They also can amortize. So they could be any of those things. It just depends on the lender and the deal and what they want to do. Mezzanine debt. So mezzanine debt, and we'll talk probably more about this when we get into the capital structure, but mezzanine debt is subordinated debt from the original lender or from the primary lender. So it bridges the gap between senior debt and equity. Now, let's say a lender can only get to 65% of value, but you don't have the equity to be able to make up the 35%. Well, you could get a mezzanine for 20%, and now you're at 85% in total loan, and now you only need to come up with a 15% in equity to do that. But mezzanine debt is extremely expensive, and it rarely works with deals. But it is something that's option. And also, it's very hard to allow for the senior debt to allow for this, for the mezzanine debt. A lot of times your senior debt will say, no, we're not going to let that happen because it makes the deal too risky. It makes it to where the senior lender doesn't really have confidence in there. And you also could have to do equity participation with them. So it's usually, the simulation is a higher interest rate, but often includes an equity participation. So if you are syndicating, if you're doing that, mezzanine debt is usually offered to people as a great way of increasing your returns, and your LPs are going to be so happy, and we're going to make all this great money. The second something goes wrong with the property, the LPs are the first ones to get squeezed. The limited partners, the people that really don't have a lot of rights or saying of what's going on, even though they've handed their money over to this investor or this management person. And if anything goes wrong, you're the first one to lose money. You get squeezed because the mezzanine is the first one to take money after the senior debt. So it's a great option. It can work. It's very few and far between, though, and when it does. The capital stack. So this is kind of where we would look at a little bit more and kind of putting in some examples and things. And so you have the senior debt, which is the first position. You have mezzanine debt, which is the second position. You have pref equity, which is also in the second position. So you can do senior debt, mezzanine debt, or pref equity. Again, pref equity is another way for you to be able to increase your returns and make everything look great for your equity investors, for your LPs and for your LPs, your limited partners. But the problem is, if anything goes wrong with the property, your limited partners start to lose money extremely fast. And it's very scary to them. And I would tell anybody who is looking to get into real estate or looking to do any of this, that the second they start seeing a deal with a capital stack where they have preferred or mezzanine, I would highly question the deal and really, really have to start doing your homework. Another in the second position is going to be your common equity, which is what you're bringing to the table. So this is very important because the senior debt is your loans that we've been talking about. And your different kinds, your bridge, your permanent loans, your CMBS, your life companies, and your common equity is in what you bring to the table. Mezzanine and debt are just ways of trying to shorten what you have to bring to the table. So, for right now, a lot of you guys are going to be trying to do senior debt and bringing equity. We're not going to be really paying attention to a lot of mezzanine or preferred yet. But as we get more experience and we get through more webinars and things, we'll kind of teach you guys how to do that if you are looking at deals where you need to do that. So, applying for a mortgage. The first is you need to prepare your loan package. You need to have a detailed proposal providing to lenders to secure the financing. You need to have what are you going to do with the money? You need to have your plan. You need to have all of your financials in order. You need to have your underwriting, your model done. You need to show the bank how this property is going to be profitable. You need to make sure you have your prior profit and loss statements. You need to have your rent rolls. You need to have all of your real estate schedule that you yourself own as well. So it's really coming up with all these things. And the key components really are your executive summary, financial statements like the profit and loss statements, any appraisals or market analysis. They call those third-party reports. So any third-party reports that could have been done on the property, any broker's opinion of value, any appraisals, any environmental things that have been done, any of that is always something good to provide to the bank as you're going and doing this. Also give them a sensitivity analysis. Show them that if anything goes wrong, you'll be able to still pay this loan or that you have the ability to keep paying the loan to them. And the process works in the sense that you're going to submit your loan application. You'll talk to the bank. The bank will either say yes or no of being an interest. They will take it to credit, which is they do a credit check and financial review of the property. If credit says yes and approves the project, as well as an investment committee that is done at the bank, then we go into closing, which is where you're ordering appraisals, you're doing all of your insurance, you're getting that together, and you're just making sure all of your doc stamps, your intangibles, your estoppels, everything is ready. Your title is going. So all those things are starting to happen. And, you're going to review your loan docs to make sure that everything is how you want it. Then after you have all the loan processing, you've done that, you've put everything together, you have your insurance, you have all of your approvals done, from insurance and from title, then you give the thumbs up, they sign loan documents, and then they fund. And they disperse everything, whether it be through a refinance or through a purchase of the property. So let's finish this up with a case study, and we will give you guys some ideas and kind of give you a little bit of underwriting for yourself. So we have a $5 million office that we're going to purchase. We're going to hope for a 70% loan to value. An interest rate is 7.5% fixed for 5 years with an amortization of 20 years. And the bank is going to want a DSCR of 1.25. Now, if we remember back from our past webinars and lectures, people remember DSCR is our debt service coverage ratio. That's how much the NOI needs to cover the debt payments to make sure that the bank is going to be happy. So the NOI needs to cover 125% of the debt payments in order for the bank to be happy and be able to want to move forward. So we're going to try to see what is our monthly payment calculation and what is the DSCR impact on approvals. So let's give a few minutes for everyone to do that, and let's see what everybody comes up with. I'll even do it with you guys so we can see, but we'll see if we can get some answers in here in a second. So for those guys, remember, so if we're gonna do it for our underwriting, remember all of our Excel underwriting that we've done. So All right. So, do we think the bank is going to approve this or not? Let's look at a couple. I'm getting a lot of no's here. Okay, all right, a couple yeses, all right, but a lot of no's. Okay, all right. So the no's would be correct. Yes. So according to our math that everyone should have gotten, we have a NOI of $560,000. Now, at 7.5%. Wait, actually. So 7.5%, 5 years on a 20-year amortization, we would get $343,000 in a payment, which would mean you'd have to bring $1.5 million to the table. So actually, based on the debt service of 343,000, then with our NOI of 560, the bank would approve of this as a 1.63 DSCR coverage. So all the no's out there, we might have to go out and figure out how we're doing our math. I don't know. Maybe you guys just looked at I think a lot of you guys just looked at the office purchase as the loan amount and didn't do the 70%. So we do actually get a 1.63 debt service coverage ratio. We have a loan amount of $3.5 million, which at a 7.5% rate on a 20-year amortization, it's $343,000 and $322 a year. So if we divide that by 12, we get $28,610,000 is going to be their payment per month. So I hope they got some good leases. That's definitely a good monthly payment. So this is always a great case study. Kind of gives you an idea of how lenders look at these buildings and how they look at things, and it gives you a good idea of kind of how you should be looking at it when you look at these problems. So, but let's look at some questions because this is the end of the lecture. So, what are the key differences between agency loans, bank loans, and CMBS, and when should each be used? So, this is a little easy. Agency loans are only going to be for multifamily or for some sort of housing. So those are only when they should be used for then, and they should be used only when they're at stabilization. The agency loans will only take properties that are fully stabilized. Bank loans are ones that can be done on any stabilized property, and it usually should be done there. Very rarely do they do bridge. In fact, they almost never do. And then CMBS also is something that should be only done on a stabilized property. But bank loans and CMBS loans can be done for almost anything, whether it be office, industrial, even hotels sometimes can be done on a CMBS loan. Next one is, how can an investor structure a deal to maximize leverage while still staying attractive to lenders? Well, being able to argue for a lower price, trying to get that cap rate as high as you can, because that really will help you. The more that the property is producing through an NOI versus what you're paying for it, is really how you're going to be able to maximize your leverage. You will also tap out, though. Certain lenders are only going to stop. Like banks will never go above 75%. So no matter what you do to maximize your leverage, as long as the property will cover that 75%, for the loan amount, that's where they're going to stop. Even if it could cover 100% of the loan, it doesn't matter. They're going to stop at that. So really, you're going to still be attracted to the way you make yourself attractive to lenders is having a good track record, being very honest, and just coming to them with a good deal and a good plan. Like that's really how to stay attractive. So what role does debt service coverage ratio play in qualifying for a CRE loan, and how can we approve it? It is one of the do-all end-alls. DSCR, if you fall below that, they will not do the deal, or they will just reduce your loan amount until it does. A lot of agency loans, like it used to be that it was just 80%. It didn't matter what the property was. When the heyday was happening 3 or 4 years ago, it was 80%. They would always get there. Now, yes, agencies can still go up to 80%, but it's DSCR constrained. It means that the 125 to make sure they have that coverage really reduces your loan amount. It is the do-all, end-all, and the only way that you can really approve it is to lower your loan amount or increase your NOI. It's the only two ways to do it at all. And a lot of times the lender will just reduce your loan amount, meaning you have to come up with more upfront cash. And then what are the common mistakes borrowers make when seeking financing for their commercial deal, and how can we afford them? Honestly, one of the big ones I see is shopping and shopping with brokers. Finding 4 or 5 brokers, giving all them the deal. They all go out. You're also going out to all these lenders and just blasting it out to everybody. That is one of the surefire ways to really turn off a lot of lenders in that, and really just kind of show that you're not really ready for the big times. That's one of the big common mistakes that I see. Another is not having all of your documents together, not having your underwriting, not having everything together that you need, and not even having an understanding really of how it works. A lot of people come in thinking they're going to get 90% or 100%, going to a bank, and that's just not it. There are lenders that do 90%, so you have to go to them, and then you will be able to discuss and work further. But you can't just go to a bank or go to a private person and be like, oh, this is what I want, or it's just not that way. Another big common mistake is approaching it through as if you're buying a home. Buying a commercial piece of property is nothing like buying a home in a lot of ways. And so really have an understanding of the process, and that is key. But really the best way that you can avoid them is doing what you're doing now, staying here at the webinars, joining Coast to Coast, hiring a brokerage firm. Coast to Coast also has a brokerage arm or consulting arm called Trinity Capital. And so having people like that you go to and ask questions, and having one broker that you trust, going to them and using them as kind of a resource, is really the ways to avoid it. And just the ways to making sure that you're not really making any of these bad mistakes. So also, though, like, mistakes are going to happen, part of the learning process. So it's just something that can go wrong. But having that broker, having that person with you, can really help you, make sure that doesn't happen. And on top of that, it helps you navigate these things and learn quicker. So, well, guys, I hope we've learned a lot, and I hope you really enjoyed here doing everything with us and learning about loans and doing some math today. And please make sure that you are always subscribing to our channels and everything. Make sure you're showing up every Thursday to these webinars. We really love having you all here. Please sign up for our newsletter and join our website as well. If you're new here and you're looking to join Coast to Coast, we'd love to have you. Please look at our website, sign up for a Calendly call. We'll have one of our hosts and one of our teachers call you guys, and really see what your goals are, and see if that we can help, and see if Coast to Coast is will be a great fit for you. Thank you so much, guys, and see you on the next one.